to our third quarter market outlook webcast. I'm Sid Queller, Head of Wealth Management at Fiduciary Trust. The second quarter started off with significant volatility, but ultimately ended up the quarter with strong investment returns across most major asset classes. To discuss that, I am joined today by our Head of Investments, Pat Donlin. Welcome, Pat.
Great to be here, Sid.
Great to see you. We're going to start today with Pat talking us through a brief presentation on the key forces shaping the economy and the markets, as well as where we might see some opportunity and risks therein. Then we'll discuss some key questions which are top of mind for our clients. Pat, over to you.
Thank you, Sid. So we'll start with looking at returns across major asset classes for the first half and for the second quarter. As you mentioned, the second quarter was really strong across the board. Every single major asset class was positive in the second quarter. The lone asset class still down for the year through the end of Q2 was U.S. small cap equities. We've mentioned before, small caps have more floating rate debt than their large cap counterparts. The Fed's been on pause, though we do think that's changing soon, but that's one issue that's been weighing on small caps. They also have less foreign revenue exposure than large caps, so they've got less of a tailwind from a weaker dollar. Non-U.S. equities are really the standout performer in the first half, and we called out Mexico, Canada, and China in particular. We've been showing that since the first quarter outlook. Those are the three countries, feels like forever ago now, but way back in February, Mexico, Canada, and China were the original targets of tariffs. And now, 4 months later, Mexico in particular is perceived as a likely beneficiary of tariffs in that a lot of companies are expected to nearshore manufacturing to Mexico. There's no universal 10% tariff rate on Mexico. It's just 25% for non-USMCA compliant goods. About 80% of Mexican exports to the United States are exempt from tariffs. On the topic of tariffs, they were really the dominant story of the quarter, obviously. Kicked off the quarter with Liberation Day on April 2nd. There's been a series of escalations and de-escalations throughout the quarter. As it stands today, which was supposed to be the original day that the reciprocal tariffs kicked in, that's now been pushed off till August 1st. There's only one trade deal officially signed. That's with the UK. And we're still waiting on legal challenges to the IEEPA tariffs, the International Emergency Economic Powers Act. Those are the ones that President Trump used to impose the universal tariffs. We likely won't know the outcome there until the Supreme Court weighs in. It's probably not going to happen until the end of the year. But in the meantime, what we're showing here is tariffs have been a major source of revenue for the government. If we look through June, tariffs are running at close to a $350 billion annualized rate. That's a $250 billion incremental increase in revenue compared to last year. And so that 250 billion, that's the number you can think of as the direct drag on corporate profits. But there are other knock-on effects that don't get captured in that, such as delayed or just foregone investment. But the good news for investors is that, or at least for corporate profits, is that the impact of tariffs is likely to be offset by an increase in fiscal deficits owing to the passage of the Big Beautiful Bill Act on the 4th of July. So our next chart here, this shows the BBB, the projected impact on the fiscal deficit each year over the next decade relative to current policy. And what that means is it doesn't include the extension of the Tax Cuts and Jobs Act, the 2017 tax cuts, because those are the tax rates already in effect today. So similar to the previous chart, we're showing the incremental impact versus the policy in place today. And a couple of things I'd note here that the first, you can see the bill's front end loaded. And what that means is several of the tax cuts are temporary. They phase out in 2028 and 2029. And then some of the spending cuts have delayed start. So they either phase in over time or they don't kick in until 2030. So basically, the bill increases the deficit, or is projected to increase the deficit more in the next few years, and then decrease it later on. And then the other thing to note is in 2026, the next fiscal year, the deficit is projected to increase by about 270 billion, which is almost the exact same amount of incremental tariff revenue being collected at the moment. So the bill is basically projected to fully offset the drag from tariffs next year. I'd also say next year, more than half of the increase in that deficit, the 270 billion, stems from corporate tax incentives that hope to boost capital expenditures. And CapEx has an economic multiplier greater than 1, which means each dollar of spending adds more than $1 to GDP. So the hope is between the combination of tariffs, which discourage imports and encourage domestic manufacturing, and business incentives to incentivize companies, give them a tax incentive to build factories here, the two will result in a manufacturing renaissance in the United States. But of course, as I mentioned, so the 2017 tax cuts aren't included in these figures. If you did include them, the actual deficit impact is projected to be several $trillion over the next decade. Though if you offset that with the anticipated tariff revenue collected, it's more like somewhere in the ballpark of $1 trillion. But still, regardless, the debt to GDP ratio is projected to continue to grow over the next decade. And the passage of this bill has investors a little concerned about the sustainability of the deficit. So since the bill passed the Senate on July 1st, we've actually seen the 10-year Treasury jump about 15 basis points. If we go to the next slide here, I think investors are correct to be concerned about the deficit. So we're showing net interest cost as a percentage of government revenue. So how much is the government paying on Treasury interest versus what they're collecting in tax revenue? And right now, nearly $1 of every $5 the government collects goes to just paying interest on the debt. And I think this chart is a big reason why you're seeing President Trump kind of publicly pressure the Fed chairman, Jerome Powell, to lower the Fed funds rate. He needs to get the interest costs down. And unfortunately for President Trump, at the moment, Jay Powell has resisted calls for rate cuts. The market's taking its cue from him. If we look at the next slide here, we're only pricing in 2 rate cuts this year, with the first one not until September. And what Jay Powell has pointed to is tariffs that we don't know what the inflation impact of tariffs are going to be. So far, there really hasn't been one. But the thought is that maybe a lot of companies had built up inventory kind of ahead of the tariffs being imposed, and they've run down that inventory. They've delayed raising their prices, but maybe in the back half of the year we start to see price increases. We're in the camp that we'd like to see the Fed cut as soon as this month's meeting at the end of July. We'd agree with Jay Powell. There's not really immediate cause for concern in the hard economic data, but the labor market is starting to show some signs of weakness. One way we've looked at this is the job openings per unemployed persons. Again, not at concerning levels, but we are now running at a level that is below the pre-pandemic average. And we've also seen the number of new jobs added continue to steadily decline, especially in the private sector, meaning non-government jobs. And we think if you look at inflation, so we show on the next slide here CPI and CPI excluding shelter. CPI still running above the Fed's target, about 2.5%, but CPI ex shelter is 1.5%, 50 basis points below the Fed's target. And we know that shelter is one of the most lagged components in the CPI index. If you look at more real-time or leading indicators of rent prices, such as the Zillow rent indices. So Zillow has a year-over-year one, which is the gold line here in this chart, and then a month-over-month annualized metric. If you plugged in either of those instead of the CPI shelter component, inflation would already be at or below the Fed's 2% target. So we think between the labor market weakness or moderating, if you want to call it that, and the fact that shelter is kind of that one component still holding inflation above target, that the Fed should really look through the tariff increase, the potential inflation increase from tariffs, and start cutting rates. But regardless of whether the Fed cuts rates later this month or they wait till September, I think the direction of travel for short-term rates is certainly lower. And we mentioned the deficit concerns put some pressure on the long end of the curve. So we think what you'll see is the yield curve is going to continue to steepen, meaning the spread between the 10-year Treasury and the 2-year Treasury will continue to increase. And that's one of the reasons we think bank stocks continue to look attractive, along with several deregulatory tailwinds. But banks make money by borrowing at short-term rates like deposits and then lending at long-term rates. And the spread between short and long, what they can make on their loans and securities and what they pay to fund those assets basically determines their profitability. So if we look at since the yield curve started to steepen back in 2023, almost exactly 2 years ago, that's the dark blue line. If you look at the relative performance of banks versus the S&P 500, they basically traded in tandem with the yield curve steepening over that time. We still think that trade has room to run as the yield curve steepened quite a bit, but still 50 basis points below the long-term average. So we continue to find bank stocks attractive here. And then last, I'd also just mention that another area we're finding attractive is international equities, specifically non-US developed market equities. And I mentioned they've outperformed year to date, and we think there's several reasons that could continue, including the big ones being fiscal expansion in Europe and then currency, that the dollar will continue to weaken. But this next chart here is showing the excess return of the S&P 500 versus the MSCI EFA index, developed market index, on a rolling 3-year basis. And I think the takeaway here is when you see the performance flip from one region to another, that outperformance tends to last for a number of years. And this latest cycle of US outperformance has lasted a lot longer than the previous cycles, but that's really the break from the historical norm. And typically, when non-US equities outperform, currency plays a particularly big role. And we do think, for a variety of reasons, the dollar is going to continue to weaken. So maybe I'll leave it there, Sid, and we can see what questions you may have.
Thanks, Pat. Very thorough, and I think something that is on the minds of most of our investors is something you already mentioned, is Jay Powell. And there was an article in the Wall Street Journal that spoke about the 2 most likely candidates to replace Powell. Love to get your thoughts on that and how that might change policy going forward.
Yeah, so it is very, very topical question, and the journal mentioned, I think, the 2 betting favorites. Of course, nowadays you can bet on pretty much everything. You can bet on who the next Fed chair will be, and they're saying that the current betting favorites are the 2 Kevins, Kevin Warsh, who's a former Fed governor, and then Kevin Hassett, who's currently the head of the National Economic Council. I think either one is. I think Trump would has certainly been tied to either one, and that's obviously why they're the betting favorites. Hassett in particular is seen as someone who would do Trump's bidding, that he may be more aggressive in cutting rates. I tend to think that Christopher Waller, who is a current Fed governor, is someone that I'd like to see appointed as the next Fed Fed chair. And just because he's been very prescient in his predictions over time. So if you go back to 2021, he was one of the few FOMC members that didn't think inflation would be transitory. And he had argued 12 months in advance of when the Fed actually started hiking rates that they should hike rates because he brought up this concept of the beverage curve, which is job vacancies versus the unemployment rate. And he said we're at a point on the curve that it was so steep that we could lose a lot of job openings without increasing the unemployment rate. And we could combat inflation at the same time. It turns out he was exactly correct. We've seen job vacancies. We showed it on a previous slide here. Job openings fell quite a bit. The unemployment rate has stayed right at around 4%. And now, Trump would like to hear, he's saying we should be cutting rates. And we're at a spot on the beverage curve where we really can't afford to lose any more job openings, or else we're going to see a big increase in unemployment. And that's what why we think Jay Powell should be cutting that. Really once unemployment starts to pick up, it tends to do it in a hurry. So if you wait for there to actually be a problem in the labor market, it's too late.
Get behind the curve.
Mm-hmm.
Tough one to answer. Does he make it to May of 2026?
I think so. So even I mentioned Waller, if he were the candidate, he's a current Fed governor. I don't think he would accept a nomination while Jay Powell is still serving. And even Kevin Warsh, who's seen as he's kind of been the most outspoken critic of Jay Powell, even he supposedly had a meeting with Trump at Mar-a-Lago and said he would advise the president against firing Powell ahead of his term. So I think Powell does stay on through the end of May.
Thank you.
But we'll see. If it doesn't, full surprise. You never do know.
Turning more to portfolios, it looked like municipal bonds lagged treasuries in the last quarter, and a number of factors that are impacting municipals. Do we still view that as a good asset class, an investable asset class, and is this a good time to consider municipals?
I think absolutely. So, I should point out too that part of that underperformance is we're comparing munis, which are basically an after-tax return versus treasuries, which are pre-tax return. But munis did cheapen relative to treasuries during the second quarter. There were some concerns earlier in the year that one of the proposals being floated as part of the big beautiful bill was that munis would lose their tax exempt status. That obviously didn't come to pass. But investors are also supposedly there's been headlines that maybe some states could be in trouble due to Medicaid cuts that could hurt state budgets. We think really what happened in the first half was just we had record issuance of munis. So there was $280 billion worth of muni issuance in the first half. And what gives me more confidence that investors aren't really worried about credit issues and it's really just this technical factor is that credit quality spreads within munis actually fell over the course of the year. So if you look at triple B munis relative to triple A munis from December 31st through this week, they've actually fallen 20, 30 basis points across the curve. So you'd expect those would have widened out if it were really credit concerns causing the sell-off. So I think munis still offer really, really attractive entry points here for taxable investors, and it's a good time to be adding there.
Great, thank you. So the Mag 7 collectively is up about 1% this year. I think in the past, mainly driven by AI trends. Seems like the AI thematic story is broadening to other asset classes. Are you seeing that in your work, and what asset classes are being impacted?
Yeah, I think that's exactly right. So and obviously, NVIDIA within the Mag 7, NVIDIA's done well. It's still up 20% this year. But I think if you look at just the S&P 500 sector returns year to date, there's an AI tie-in across all the best performers. So industrials are actually the best performing sector this year. Utilities are the second best performer. And really, that if you look under the hood at industrials, there are kind of a lot of different industries within that sector. But the best performing is GE Vernova, the best performing company. And they make natural gas turbines and other equipment that either helps generate or transmit electricity. And then utilities obviously are increasing their generative capacity, which allows them to grow their earnings. But it's all in response to an increase in electricity demand from AI data centers. And then the third best performing sector this year is financials. I mentioned we like banks in particular. Banks have done even better than the sector. But banks are kind of one of the early adopters of AI in part. So banks kind of have these vast amounts of structured data, which makes AI implementation a little more straightforward than it is in many other industries. And so banks are using AI already to assess credit risk more precisely or detect fraud in real time. streamline operations. So ultimately, we think it's going to help them reduce non-interest expense, increase revenue, and just increase the return on equity in the industry. So I think you're right. The AI trade is broadening out. It's not just those 7 names that it's AI adjacent and kind of the phase 2 AI beneficiaries now.
So AI seems to be one of the macro trends that everybody's spending a lot of time on, focusing on how that's going to impact us going forward. The other trend that's on the minds of most of our clients is hard to pick up a financial paper or watch a news show without hearing about the dollar losing its reserve currency status. Love to hear your thoughts on that, and maybe some historical perspective on why we might not want to be worried.
Yeah, that's one of the more frequent questions we get, actually, and we have been, in the outlook we wrote, we've been a little bearish on the dollar, but that's not to say we think it's going to lose reserve currency status. So partially, a reserve currency needs to have very large, deep, liquid capital markets, and there's really no other country that offers anything close to the scale of U.S. financial markets. And that's one big reason we think the dollar's not going to lose its reserve currency status anytime soon. But it's not inconsistent, I think, to say the dollar can still depreciate significantly. And you don't have to go that far back. Go to the early 2000s. We saw the dollar fall 40% over a 6-year period. But it's been the reserve currency since 1940. So I think one of the big reasons, for example, we think the dollar is going to continue to weaken is just foreign hedging of their U.S. dollar assets, not necessarily selling U.S. dollar investments or selling dollars, but just hedging, which affects the dollar's price in foreign exchange markets. So, we think there's more depreciation ahead for the dollar, partly because the administration wants that, but it's not going to lose its reserve currency status.
Good to know. Seems to be on the top of everybody's minds these days. So, Pat, let's end it there. Want to thank you for your perspective on these important topics. I know that you and our investment team will continue to stay on top of the key forces shaping the economy and the market. I'd also like to thank the audience for joining us today. If you have questions, please reach out to your fiduciary trust investment officer or me. My contact information is on the following page, and thank you again for joining us today.
I encourage you to access some of our knowledge through insights on our website, fidtrustco.com, as well as by reaching out to your fiduciary trust officer or to Sid Queller at 617-292-6799 or at queller@fiduciary-trust.com. Thank you again for joining us, and we wish you and your family health and well-being.
The opinions expressed in this material are as of the date issued and subject to change at any time. They discuss general market conditions and trends and should not be construed as investment advice. Any reference to specific securities are for illustrative purposes only and are not intended to be and should not be interpreted as recommendations to purchase or sell such securities. Nothing contained herein is intended to constitute investment, legal, tax, or accounting advice, and you should discuss any proposed arrangement or transaction with your investment, legal, or tax advisor. Copyright Fiduciary Trust Company.